Howdy traders, welcome back to the ranch. Today we're tackling a topic that sounds like rocket science, but it's actually one of the most powerful tools in a day trader's tool belt, and that is options. Most people tend to avoid them because they're kind of, I guess, scared and intimidated by all of the jargon. It's stuff like theta, gamma, iron condor, and it just makes a lot of people want to run back to the simple stocks or even futures if you're used to that. But here's the truth. If you can understand a basic real estate contract or a cattle trade, you can understand options. In this video, we aren't just going to go over definitions. We're also going to cover the 4 pillars of an option, the ice cube effect that kills most beginner accounts when you're not used to dealing with options, and why options might actually be safer than futures in a lot of ways. So if you've ever wanted to control 100 shares of something like SPY for the price of a steak dinner, grab your notebook because we're going to go to school. So technically, an option is just a contract. That's it. It's not actually a stock that you can own and hold. It's a contract that you're owning. So let's use a ranch analogy to try and make this stick. So imagine there's a beautiful 100-acre plot of land in Degen, Texas. It's currently worth $1 million. And you have a tip that a new highway is being built right next to it. It's one of Elon's superhighways. And having that there could double the value of that property in the next 6 months. But you don't want to spend $1 million right now. You don't have $1 million right now, maybe. And you definitely don't want to take out a massive loan if you aren't 100% sure about this rumor about this Elon superhighway about to come through this piece of land. So let's say you go to the owner and you say, I'll pay $5,000 to you today for the right to buy this land for $1 million anytime in the next 6 months. So the owner is going to keep your $5,000. That's the premium that you're paying for that option right to buy that, okay? So now you have a contract to buy the property. That contract cost you $5,000, not $1 million. Now we've got 2 scenarios to talk about. The first scenario is, yay, the highway gets built and the land is now worth $2 million. So you can exercise your option to buy it for the agreed $1 million, and you just made a massive profit for only a $5,000 investment. On the other hand, if things don't go according to plan and the highway project is canceled, the land is still worth $1 million, and you let that contract expire because you weren't on the hook for the land, you were on the hook for the contract. So you lost your $5,000 that you were paying for this contract, but you didn't lose any money or get on the hook for anything crazy like you would have if you'd bought the land outright and then this deal fell through. I mean, it could even be worth less at the end of the day, right? So that's where you get that defined risk, which can be the edge in options. So in options, you know exactly what you can lose before you even start the trade. You know what your max risk is. So let's get into the nitty-gritty of that ranch contract. Why does the owner agree to this in the first place? So in the trading world, there's always a buyer and a seller. So when you buy a call, you're paying for the right. You have no obligation to do anything. So if the market crashes, you can just walk away. But the person who sold you the contract, they have the obligation. They're the house, they're the insurance company. So why is that important for your trading strategy? Because when you're a beginner, you need to be able to decide which side of the fence that you want to sit on. Most of us will want to just start out as simple buyers, but a lot of times the real wealth at the ranch is often made by the landowners, and that's the sellers. And you can get really creative and do a lot of different things with options. So Every single number that you see on an option chain represents a real person looking to make a deal. Speaking of the option chain, in order to read an option chain like a pro, you need to really master the 4 pillars. So pillar number 1 is the underlying. This is the stock or ETF. For me as an index trader, a lot of times that's the SPY or the QQQ, but it could be something else you're interested in, like Apple or Colgate or American Airlines. All right. Pillar number 2 is the strike price. This is the line in the sand. It's the price where you agree to buy the stock at. We were agreeing to buy that ranch for $1 million. Pillar number 3 is the expiration date. So this is the timer. Unlike stocks, options don't last forever because these are contracts and they have end dates. So that's where the ice cube comes in. Every day you hold an option, it melts a little bit, and that's called theta. So pillar number 4 is the premium. And this is the cost of admission, the cost of doing business. And that's what you pay to own the contract. And a lot of beginners like to buy out of the money options because they're the cheap ones. It's like buying a lottery ticket, but you're really in the nosebleeds sometimes. And at the Trading Ranch, a lot of the times we focus on buying at the money or just a little bit in the money because they end up having a higher probability of profit. That's why they're in the money and how a lot of that math will come to be. But let's get back to the technical stuff and talk about the math monsters under the bed, the Greeks. You don't need a PhD to understand these, as intimidating as they are. You just need to understand them like the dashboard of your trade. So first is the delta. That's your speedometer. It tells you how much the option price will move for every $1 that the stock moves. So if your delta is 0.50 and SPY goes up $1, your option goes up 50 cents. But here's a little tip. Delta represents the probability that the option will expire in the money. So a 0.10 delta is basically a 10% chance of winning. So are you a gambler or a trader? Maybe you don't want to buy the 10% chance just because it's cheap, where at the money and in the money is going to have 50% or greater, basically. Next is theta, and this is your hourglass, your melting ice cube. This is the most important Greek for beginners to learn to respect because while you sleep, your option is losing value every single night that you hold that thing. So this is why a lot of the times we're not looking to buy and hold options like we do stocks. Options are really more for renting that option and not looking to own the thing. So we're looking for big moves that happen on our time frame. And third is Vega. So this is like a volatility thermometer. It measures the fear in the market. So when people get scared, the Vega goes up and the options get expensive. And if you buy when Vega is high and then the market calms down, you're going to lose money even if the stock didn't move. It's like a silent killer that catches a lot of new traders off guard, but not you, because you're going to be paying attention to that. Now let's get to calls and puts, and let's think about it like an elevator. So with calls, you think the market is going to go up. Buying a call gives you a right to call the stock away from someone else at a lower price. With puts, you think the market is going to go down. So buying a put gives you a right to put the stock to someone else at a higher price. Things can start getting more complicated because we can do more advanced trades instead of just buying and then selling. We can sell to open or do a combination with different strike prices and dates. But basically this opens up a whole new world of possibilities where if you're selling the option, you kind of end up being the insurance company. You collect the premium up front and you win as long as the stock doesn't move against you. So that's where you hear a lot of people talking about the income side of options, where they're using options for regular income. And we can cover that more in a later series. But for now, I really just want to focus on mastering being a buyer so you really understand the risk of the options, and then we can move on from there. So why do a lot of people lose money even if they guess the direction right? With options, a lot of the time it comes down to IV crush. And what that stands for is the implied volatility crush. And that's what happens after an earnings report or a big Fed meeting or anything really volatile that the stock is kind of waiting on. So once that uncertainty disappears, the price of that option collapses even if the stock stayed flat, because that part of the premium was part of the implied volatility. It's a huge mistake that I see a lot of new traders make, because they want to buy it right before the news, and then that premium literally gets crushed after the news. So you need to also check the IV before you click a buy button, especially if there's earnings or any big news events coming up. And if you're wondering, Barbie, I already trade futures, why do I need options? And here's a bit of a truth bomb for you. Futures are linear. So if the market goes against you 10 points, you lose a fixed amount of money. There's no floor. So if the market gaps down overnight, you can lose a lot of money if you're sitting in futures. And if you wanted to do an overnight type of idea or a longer type of idea, you can do that with options. And with options, your risk is capped at the premium. So if you buy a SPY put for $500, the absolute most that you can lose is $500, period, no matter how bad the market crashes. And y'all know that's different in futures if you trade futures. So you can sleep like a baby, really knowing that your stop loss is built into the contract itself. As the worst case scenario, you can still put a higher stop loss on it and manage your trades elsewhere. But before we get into the details of like managing trades and all of the little things like that, let's talk a little bit about margin. So in order to trade one E-mini S&P 500 contract, you really need a pretty large amount of margin. You might be able to get away with a lot less than that at a futures broker, but still, if you were going to control that same amount of stock with an option, you might only need a few $100s. And this is how we can scale and do a lot of different ideas without having that multi-million-dollar bankroll. So we use the highly leveraged option contract to control the same amount of cattle with a smaller fence. So how do you start without blowing your account? Don't go out and buy 100 contracts on a Monday. This is not like trading small caps where we're just loading everything up. So rule number one is start out with a paper trading account for your first 5 or so trades and really get that muscle memory of the option chain down first. And then just kind of pick one pet stock. I only trade the SPY when I'm trying to focus on things. It's the most liquid, it's easy to understand, and it has some pretty fair pricing for beginners. So it's one I suggest to beginners a lot. Options aren't so scary. They're just another way to express your view on the market with less capital and a little more protection than using the full amount that you would use for stocks or having a futures contract that can get liquidated and move against you pretty quickly. So if this helped you clear some of that jargon fog from options, hit the like button and drop me a cowboy emoji in comments. That'll let me know you made it this far. And after you watch the next video, come join us in the ranch. We are covering options nonstop and even having monthly classes on it live in the ranch right now. That's it for now. All right. Love you. Bye.